Welcome to the Kitchen Table Finance Podcast, where we make retirement planning easy and enjoyable. Discover practical advice to create a retirement strategy that fits your lifestyle and budget.
Hey Dave, how you doing today?
I'm doing fine, Nick. Sucking on cough drops so that I can talk my way through this prediction podcast.
Tis the season. Welcome
Yes,
to January in Michigan. Seems like everybody is sick all of a sudden.
it is the case.
It's
Uh,
an interesting dynamic coming out 3 years out of the pandemic, right?
right.
Alas, here we are. So, Dave, I think this is probably one of your favorite episodes, right? The 2024 predictions where we get to see how
Yo,
foolish we looked last year.
yeah. Along with everybody else who's paid a lot more to predict things than we are. So
That is true.
I
That is
think
true.
we can always say that our predictions are about worth what we get paid to make them.
Yeah, exactly. Not
On the
much.
other hand, there's some big time macroeconomists out there who maybe have some splaining to do from last year.
Yeah, exactly. So, to our listeners, if this is your first prediction season episode, we've been doing this. I think this is our third year, Dave, if I'm not
It is.
mistaken.
It is.
So,
This is episode 3 of this series.
yeah, and the whole point of it is to A, make ourselves look ridiculous, but B, look at how futile and useless it is to make predictions about the future of the stock market in the short run.
Our joint personal hero Morgan Housel wrote that predictions are pretty much useless when it comes to the stock market, but we also feel stupid not making them.
Yeah,
right. I think he says irrational. We feel irrational not making predictions.
Yeah,
and I can't tell you how many times over the years I've said to very good clients, serious clients, when they've said, well, what do you think is going to happen this year? And I've said, well, I really have no idea in the short run. And they're like, oh yeah, we know you always say that, but what do you think is going to happen? and then you have to say something, right?
Right. Yeah, exactly.
So
we are forcing ourselves today to say something. And so we will get to that part. But first, let's look at how we did last year, Dave. So in our predictions last year for 2023,
yes,
your prediction, Dave, was that the S&P 500 would basically be flat. And when I pushed you on it, you said it would end at 4,100.
Right. And that was not the case. The market was up 26% last year.
That's right.
Which you were halfway there, not quite halfway, with a prediction that the S&P would be up 12% for the year. So kudos to you.
I was a bit more optimistic with 12% for the S&P 500 last year.
Now,
yeah, I mean, to keep in mind, like sitting where we were last year, the big worry, the big concern was we're going to go into a recession. The Fed's going to increase interest rates. It's going to destroy the economy, yada, yada, yada. They'll never get a soft landing right, yada, yada, yada.
Well, let's talk about what all the major Wall Street firms were predicting in December, January 2022, 2023. That by third quarter, give or take, depending on who you wanted to listen to, the United States would be in a recession, the world would follow, and we'd see the Fed had overdone it on raising interest rates and choked the economy off, and corporate earnings would collapse, and we'd have unemployment and all kinds of issues, and didn't sound very promising. And if pressed on my prediction last year, actually what I was thinking is that the market would take a severe dip and get back to even. And I don't think I quite expressed it that way when we recorded it, but that was kind of what I had in mind, that the middle of the year would be pretty ugly, but we'd probably climb out of it fairly quickly and get back to where we were.
Yeah.
But none of that came to pass, right?
Yeah. Well, we both took a little bit of a contrarian point of view last year because the majority of Wall Street firms were predicting recession.
Right.
And so usually what happens is when everybody's predicting one thing, the opposite happens, right?
Yeah.
That was no more true last year than ever before, right?
Yeah. Actually, I think we both felt a little brave. Even with my flat prediction, I was feeling a little brave about stepping out from the crowd as a contrarian there.
Yeah.
But here we are, and all it does is underline how impossible it is for not you and me, but the people that get paid millions of dollars to sit in very shiny offices on Wall Street and crunch numbers and try to figure out what direction things are going to head, rarely get it right.
Yeah, absolutely. So just, Dave, rounding out our 2023 predictions, I like to make multiple because that way maybe one of them will be somewhat right.
Yeah,
So
throwing up stuff against the
yeah.
wall.
So I think for the second year in a row, I thought that international was going to outperform the U.S., and that did not come true. And nothing worse in terms of my predictions than the fact that I thought tech would continue to lag and have layoffs because the NASDAQ was up somewhere around 50% last year. So that was a pretty bad beat. And then the last one is also another pretty bad take, and that was that the crypto fallout would continue, and we would see crypto continue to fall. Bitcoin was up around 50% last year. Keep in mind, this was on like the tail end of the Sam Bankman-Fried FTX failure, and has since been sentenced to some prison time, and that did not go well for him, but crypto has managed to kind of ignore that and bounce back a little bit and have a really positive year last year. So just goes to show you, I don't know my left leg from my right when it comes to making predictions.
No.
But that's why you make multiple, right? Maybe one of them will hit.
Right. Well,
and then lastly, you this wasn't necessarily a prediction, so to speak, but you did state that stocks and bonds will return to kind of a normal in terms of their relationship, because in 2022 we had seen stocks and bonds go down at the same time.
Yeah, and I guess you could say that prediction was not correct for 2023 either, but in the other direction, that both stocks and bonds were up for the year. But we're kind of poised in a situation now where if the economy slows down, we would see bonds go up because interest rates are higher now. So
Right.
that yin and yang of what's bad for the stock market is probably going to be good for the bond market, where it's kind of back in place. So
absolutely,
even though it hasn't played out yet, I don't feel
partly
bad
correct.
about that.
We just haven't proved it, right?
Right. Well, I don't feel that was too bold a statement though either. Yeah. That was more out of frustration over all of the balanced portfolios are dead theories that were
death of the 60-40 portfolio that was all over the place. So
which had its best year in a long time in 2023. So anyway, here we are.
That's right. Enough of 2023, Dave. What's going to happen this year?
So looking around at what the broad-based predictions for the stock market are for this year, Forbes put together kind of a consolidated view of all the major investment houses out there and what they had to say, and kind of settled on the expectation that we'll see 8 to 9% gains on U.S. I believe they were being more specific about the S&P 500 there. So, with outliers on either side, and, Goldman Sachs is a good example. They came in right at 8%. JP Morgan, and, I like their economic analysis, not necessarily predictions, but their economic analysis better than most. And they actually have a negative outlook for this year, looking at the S&P 500 closing around 4,200. Wow. So that would be around they think that, and I find myself kind of drifting towards their line of thinking, that the way the markets are poised right now in the short term, all the good news is kind of priced into the market, right?
Yeah.
That the things that would be good for the stock market are already, the stock market's gone up anticipating that interest rates are going to go down, inflation is going to continue to be more controlled, and the Fed will actually start cutting rates sometime in the second half of 2024. And if any of those things don't play out smoothly, it's likely to be a bumpy ride.
Yeah, we can look at the tech stocks. A lot of that was last year was AI was being priced in, even though it didn't really affect revenue. People, basically priced it all in. So again, if that technology doesn't come on as fast as we thought, you could see a pullback there too, potentially.
Yeah. So, the contrarian view this year, which which JP Morgan's kind of an outlier there as far as the major firms goes, is that maybe we are just still waiting on some of the bad news that got postponed from last year.
Right.
Merrill Lynch, on the other hand, their prediction basically boiled down to, and I forget their exact number. In fact, I don't think they made an exact prediction, but their point of view was that the good news is not all priced into the market, and that's a faulty assumption.
Yeah.
That even if it plays out close to the base case, there's still upside potential. So that seems to be where kind of the consensus is, that we're not priced for perfection. But there was a really good article the week between Christmas and New Year's from the Wall Street Journal talking about the soft landing that we've talked about, which is where the Fed has increased interest rates, brought inflation under control, and not crashed the economy, coming in for a soft landing. And they called it the most crowded trade in Wall Street right now, meaning that's where everybody has put their money,
right,
and everybody's betting. And if you think back to how everybody bet last year based on things being pretty ugly that didn't come to pass, it kind of makes you take a little bit of pause when you see
for sure.
those rosy predictions, right? And
for
it's
sure.
funny too, in that Forbes article that summarized all this stuff, their comment was, by and large, Wall Street banks don't expect the market to be as good as usual. It will only be 8 or 9% positive, and I'm thinking about it from my investor client's point of view, like, hey, an 8 or 9% year on the stock market, we'll take that, right?
Right.
But yeah, that's a shade under like the long-term averages.
Yeah.
So
well, it just goes to show you like how hard it is to predict and project this stuff. I mean, you've got Merrill Lynch and JP Morgan, which are probably sitting in offices across the street on Wall Street, looking at the same data, coming up with completely different, completely opposite, like predictions about what's going to happen and why.
Yeah.
Like, I mean, it's just impossible. But
now there are things you can look at in terms of the long term that make more sense. And every year it seems like more of these big firms are making like 10-decade predictions rather than like what's going to happen in the next 12 months. Well, we've proven that we don't know, right?
Right.
I mean,
right.
but we can look at things like valuations. When the stock market is priced higher compared to what corporate earnings are, we expect that over the next decade there'd be some underperformance.
Right.
And vice versa. If valuations are lower than usual, then we expect over the next 10 years or so to see outperformance. And so like Vanguard, and I've actually got a chart of them here, kind of talk through them, but Vanguard, their commentary was around the like what's going on in the current time frame. High rates are likely here to stay for a while. We're not going to see interest rates come down very fast. It's good for savers and it's good for sound monetary policy. It puts some juice back in bonds. We like all these things. They're looking at where stock valuations are, and they're saying, we expect 4.2% to 6% 10-year annualized returns for the U.S. market.
Okay.
Now, that doesn't sound horrible, but that's also 3 or 4 percentage points lower than historical long-term averages, right?
Right.
So they're basically saying, I mean, it's a nice way of saying buckle up because this could be a rocky decade coming ahead of us. They were a little bit more bullish on international developed stocks, figuring 7 to 9% based on, again, valuations, because we've seen the U.S. stock market outperform. We would now expect they'll underperform a little bit. While we see some outperformance from international that's underperformed. So it's more of a just shifting of the weight in a way.
Right. Which also helps answer the age-old question of why do I have international in my portfolio again, right?
Right. And when we look at some of the other longer-term projections, BlackRock is kind of right in the middle of the Vanguard long-term projections at 5.2. JP Morgan, despite their being kind of bearish this year, they're still sitting at 7% for their longer term. But again, that's a little less than the 9% or so that we've seen in U.S. large caps. And Morningstar's figuring about 4.6%, and and Schwab's at about 6.2, so kind of in line with the higher end of Vanguard's ratings. But I like the one. So that my main takeaway there is not those specific numbers,
Right.
but that all of those are expecting that it's going to be harder to make money in the stock market over the next 10 years than it has been over history. That there's going to
Mm-hmm.
be more um, more challenges unless the things that come to my mind are unless AI really changes the productivity paradigm, things like
Right.
that, which we just don't know yet.
Mm-hmm.
Um, but just based on where earnings are and where stock valuations are right now, that's how
Mm-hmm.
it looks.
Yeah, it's interesting because it's definitely easier to predict 10-year returns, like to be like
Yeah,
reasonably close,
yeah,
but
yeah.
also it's not like a perfect science, right? Like
Right, right,
10 years is still not far enough out to really
right.
get to, an
Well,
exact number or
and
range.
this gets at a big behavioral stumbling block for the human brain and investments. So, Nick, if
Mm-hmm.
I ask you, what are you going to be doing an hour from now? You've got a pretty good idea, right?
Yep. Eat
And
lunch.
if I ask you what you're going to be doing next January 8th around noon, you've got a decent idea, right?
Yep.
If
Mm-hmm.
I ask you what you're going to be doing on January 8th, 2034, it gets a little more sketchy, right?
Yeah, for
The
sure.
further out we go in time, the harder it is
Mm-hmm.
to predict things
Right.
in the real, like the regular world.
Right.
And what in the laws of wealth, Daniel Crosby talks about this. He calls it Wall Street Bizarro world.
Yeah.
And he says in Wall Street Bizarro world, several things aren't the way they are in the regular world, and that's one of them. We have no idea what the stock market's going to do tomorrow, right?
Right.
We've got
Mm-hmm.
very little idea what it's going to do a year from now, but we can, with fairly reasonable certainty, say that
Right.
unless the whole world is something we no longer recognize, the stock
Yeah.
market will probably be somewhere around, an annualized average,
Right.
within shouting distance of its historical norms. And
Right.
that's part of why our brain fights this so much,
Yeah.
because it's the
Mm-hmm.
opposite of the normal world.
Right. Yeah. Super interesting.
Yeah.
But definitely a good takeaway. And, a lot of this stuff is important in financial planning terms because when you're
Hmm.
writing financial plans, you need to, it makes prudent sense to maybe back off of, and instead of using a 10% rate of return over
Hmm.
the next 10 years, you probably want to back off of that a little bit given
Right.
where valuations are and
Right.
all this stuff. So
Right.
that does have a major impact on what kind of what kind of outcomes you're getting and what that looks like.
Right. And one thing I've always liked about the software we use is that it uses the Monte Carlo analysis, which we've talked about before, which is it's pros and cons, but is better than assuming smooth returns. But also,
Hmm.
when we do have to hang our hat on averages, we're using a handicap based on valuations that
Right.
comes in, for the last several years. Their estimates have come in kind of in line with what Vanguard and some of these other houses are saying, that it's going to be hard to keep up the 10% for a while.
Right.
So
Because what you don't want is to plan on 10 and get,
right,
6.
right,
If you plan on 6 and get 10, you can work with that. But if you plan on 10 and get 6, things are going to get tough.
right, right.
So, Dave, without further ado, I guess this is the point in the show where we
Here
make
we
our
go.
predictions for 2024. You want to start us off?
I was thinking I might unplug my microphone and pretend I was having technical difficulties. So, my contrarian nature probably isn't as extreme as JP Morgan's,
Mm-hmm.
because every time I've been pessimistic, I've been up, surprised to the other side over most of my career. So I'm going to go with this pretty much the same prediction as last year. I expect we're going to end up after a wild ride this year of somewhere right around where we are right now.
Okay. I like it. So I'm going to go kind of in the opposite direction, Dave, and let me explain why. First, I'm going to put out my number. I'm going to say the US stock market is going to be up 22% next year. And
Wow.
here's why, Dave. I think you're going to like this. Although I don't know exactly where the U.S. stock market is, what I do know is that the Detroit Lions are going to win the Super Bowl this year. And there is a correlation between an NFC team winning the Super Bowl and the stock market being on a bull run versus the AFC team.
Yes.
And so I am banking on my Detroit Lions winning the Super Bowl and the stock market being in a bull
therefore
at 22%. Laying it on the line.
If ever there was an NFC team that could make that, like, makes that come, because growing up in Michigan, if the Lions can win the Super Bowl, anything positive is possible.
That's
Anything
right.
could happen. Anything could happen. There is no reason to be pessimistic at all.
That's right.
Case. So
I love it.
We'll know in a couple weeks then.
The world, yeah, exactly. It hasn't been 1953 since their last championship, 1991 since their last playoff win.
Yes.
Throwing all the chips in this year. 2024 is going to be the year.
Here we go. Buckle up.
So, other than the U.S. stock market, Dave, what do you have other predictions for us for 2024?
This is going to be the year that international outperforms.
All right,
U.S.
throwing
stocks.
it in there.
I'm going with it.
I like it. I'm going to go the opposite way just because I say it every year and it doesn't come true. So this will be the year that it probably doesn't come true, or that it does come true, because I'm going to predict that the U.S. market is going to outperform international again.
All right.
Throwing it all out there. Any other predictions for us for 2024?
Oh, boy. Wherever the market ends up, there'll be big swings in the middle, and we're going to be scared and overly optimistic all at the same time.
I will be shocked if that one doesn't come true, considering that 2024 is an election year and things are going to get weird.
Things will get weird, and then we'll look back after a while and we'll say, well, why did we let that affect the market?
Right, exactly.
And I think we'll have plenty more to say between now and October, November about how the elections and the markets play together.
Absolutely. I'm going to give you one more, Dave. I believe that we are going to see a whole bunch of increased transactions in the real estate market. I think once we start to see interest rates come down, we're going to see more people willing to give up their 3% interest rate for a 5% to make a move they've been holding off on. I don't necessarily know that prices are going to go up, but usually when you have demand go up, you have prices go up. So I think you're going to continue to see a lot of transactions in the housing market. I think that picks up. I think we've just had a couple people holding off, and if interest rates go down, we got a bunch of people wanting to buy and a bunch of people holding out. So that's my prediction.
That's interesting, and that could take up an hour's worth of consideration too, because one thing that I think is likely to happen is the longer interest rates stay higher, the more habituated we become to higher rates, right?
Right. Yeah, absolutely.
And the reason a 6% mortgage seems extreme right now is not, it doesn't have anything to do with history in the long term. It's about our recency bias that 3% has been the norm. 3% was kind of the low extreme, but yeah, we've become
10,
used to those
years.
4% numbers, and the longer it stays high, the more likely people are to accept that. But part of my backing up to what I was thinking about the markets is I'm not so convinced interest rates are going to come down. So that's one of my concerns, is that we've built in this expectation that interest rates are going to be lower, and I'm not sure that's going to play out that way. Right. And the stock market is going to hate that.
Yeah, that's a great point, because inflation isn't exactly where they want it.
Right.
So, and because the market is doing well, because the economy is doing well, they might not lower. They could just hit pause for a while. And that could carry on for some time.
So we shall see. We shall see. I don't have any other bold and daring predictions to make around that.
That's all I've got for this year as well. Some pretty basic ones. We will check in next January and see how we did, Dave. But as always, this has been
I
fun.
sure hope you're right. I hope I'm able to congratulate you again this year for beating me again in our prediction contest.
Which one would you rather see? A 22% stock market increase or the Lions winning the Super Bowl? That's the real question.
22% stock market increase.
Like it.
All day long. If the one leads to the other, great. Great.
I love it. Well, thanks, Dave. If our listeners have predictions they would like to make, send us an email, info@srbadvisors.com. We would love to hear it. As always, Dave, it has been a pleasure.
It's been fun. Thanks, Nick.
This is a Zedia Media production.